All right, welcome everyone to Value Investing Live. I am pleased to welcome our guest this week, Adam Abbas, who is the co-manager of the Oakmark Bond Fund and the Oakmark Equity and Income Fund. For everyone joining us today, and I do see some of you are beating me to the punch already, do please say hi to the chat. Let us know where you are viewing from. We always love seeing those international audience members out there. As always, please feel free to post those questions and comments throughout the presentation. We will hit on them once we get to the Q&A at the end. And Dale, I'm glad to hear that you are enjoying our little intro music there as well. Without anything further from me, though, I'm going to go ahead and hand things over to Adam. We can go ahead and jump into the presentation.
Great. First off, thanks, Graham, for the opportunity to be a guest. Also, thanks to the listeners of GuruFocus. I know you have hosted some of my colleagues, most notably Bill Nygren, our firm's CIO, and I know several folks from our research that value this platform as a resource to understand how others approach investment management and valuation. This isn't the typical presentation in that most of the time you are interviewing equity portfolio managers, and I'm a fixed income portfolio manager. So I hope, one, I want to present a unique perspective from a fixed income lens that doesn't bore you. The fixed income world is sometimes perceived as quite dry. And two, I also hopefully want to show the connective tissue that actually exists between the Oakmark value approach to equities, what they've been doing for 4 decades, over 4 decades now, and is regarded as one of the best, kind of the gold standard for value investing in the mutual fund space for equities, and show that connective tissue to how we approach valuation in the fixed income space. Ooh. Just before we jump into the presentation, I did want to give a little on my background. I've been in Chicago for all my career, where all of my post-secondary education has taken place as well. I came up as an analyst within Lehman Brothers Asset Management, which became Neuberger Berman in 2010, and then have managed and co-managed various fixed income vehicles over the last decade. Importantly, I joined Harris in 2018 to help expand the Oakmark family of funds into the dedicated fixed income arena, and help launch the Oakmark Bond Fund less than 2 years later in June of 2020 with my co-PM Colin Hudson. When I joined, I couldn't have been more excited for the opportunity to help a company that, again, is one of the best value brands, value track records in the mutual fund business, and help the firm move into this dedicated fixed income space. Just in case this is the first time you've heard of Harris and the Oakmark Funds, this is in graphical form, shows the storied history of Harris Associates and the mutual fund families. We launched in 1976. We are around 120 billion of assets. We've amassed that over roughly the last 4 decades, mostly in value equity, in the mutual fund arena and separate accounts. The critical mass of mutual fund assets are spread across 3 main funds: the Oakmark Fund, the Oakmark International Fund, and the Oakmark Equity and Income Fund, under Clyde McGregor, who I get the luxury of working with every day as co-PM in the Balance product. All funds, important to note, all funds, regardless of geography or asset mix, deploy the Oakmark value philosophy, investing in assets in truly a bottoms-up manner, ensuring we are buying companies at a discount to our intrinsic value and determining our valuation over long time horizons, not concerned with short-run noise or phenomenon. Moving to the next page. So let's just zoom into the fixed income platform quickly with some key milestones, and then a little bit more background there, and then we'll get into the meat of the presentation. Although we are very well known as an equity manager, some might not know that Harris and the Oakmark mutual funds have been managing fixed income assets for over 25 years in its balanced product, equity and income product. So the expertise and investment philosophy has been tested over 2.5 decades of credit cycles and markets ups and downs. It's really just more recently, really the last 5 years, that the firm and leadership have made a concerted effort to ramp up resources to allow for the buildup of a dedicated fixed income platform. And this effort to ramp up resources really stemmed from our conviction through full proof of concept from what we've done in the equity and income fund and the balance strategy, but also that our value approach we truly believe absolutely traveled across asset classes, and that instead extending into a dedicated fixed income arena was simply a natural and adjacent move instead of some large leap. And this natural extension from equities into fixed income should become more evident through this presentation. Just to highlight a few milestones on the slide, you'll see the key resources added over the last 5 years with multiple senior professionals. I think we've added around 50 years of combined fixed income experience over that time period. And then the culmination of that ramp up of resources, really the launch of the Oakmark Bond Fund in June of 2020. So with that, a little background, now let's get into the meat of the presentation. I'll lead off with our investment philosophy, some 3 key tenets that we think about in fixed income, walk through 2 examples, and then I'll open it up for Q&A. So today we want to talk about 3 key tenets that really make us unique, we believe, versus a lot of the more traditional debt shops out there. By no mistake, these 3 key tenets you see on your screen, we are talking about today, look and sound very similar to our approach to valuing equities, and that is by design. Although there are several nuances, characteristics of our valuation process that requires slightly different lens and some nuance, these 3 pillars that form the foundation of what we do every day and how we find value are very similar to our equity process. First, we want to seek out debt investments where credit risk is not reflective of the intrinsic value of the underlying business. Second, we want to invest in companies that are growing value per dollar of debt as means to taking down leverage organically, and avoid the secularly challenged businesses that are shrinking and relying on the declining cash levels to pay down debt and ultimately remain solvent. Third, we want to be aligned with management. We want to think and act like owners. This applies to debt as well. So when we look at capital allocation decisions, possible M&A, we want to ensure that they're investing like an owner would with 100% skin in the game. That means properly balancing balance sheet risk considerations with growth, making smart capital allocation decisions based on a consistent return on capital framework. It means assessing acquisitions and divestitures just as an owner would, with all the skin in the game. We find that when we have all 3 of these things, we can find successful long-term debt holdings that provide strong risk-adjusted returns. And long-term is key there. At Oakmark, we invest over long time horizons. We're not trying to trade in and out of credit markets. We're not trying to exploit short-term technicals. We're not trying to market time. We want to turn down the near-term noise, if you will, turn it down and really assess a business value over the medium to long term, and then apply what that means for default risk. This is effectively a private debt underwriting approach to public debt markets. And so let me dig into those three tenets. Determining intrinsic value. So why, if this is a credit valuation exercise, not equities, why does determining the total business worth even matter? Should I only be concerned with traditional credit metrics like free cash flow, interest coverage, how much the company's profitability covers cash interest, leverage, the profitability versus the amount of debt? The answer, we believe, is absolutely not. It's an incomplete picture. It's certainly part of the equation, but it's an incomplete picture. And at Harris, as debt investors, we are always first and foremost keenly interested in understanding the intrinsic worth of a business versus the debt it has on its balance sheet. Think of this as loan to value cushion, but with some more sophistication. In Harris's case, it's loan to intrinsic value. We believe that the best opportunities in the marketplace are ones that the debt market are underappreciating the intrinsic value of the business and choosing to focus only on traditional credit metrics. So how do we find these opportunities? How do we determine intrinsic value at Harris, both in equity and in debt? This isn't simply just a price to book calculation or a price to earnings calculation. There isn't one plug. We really define it more generally at the firm as the maximum price that an all cash buyer could pay for an entire business and earn an adequate rate of return. And so how do our analysts capture that? Well, we spend a lot of time in research looking at historical data on PMVs, private market valuations of like companies. We look at those transactions. We assess the similarities and differences in those PMVs versus our company that we're evaluating. We build out a public comp set for each of our names in the peer group, and we compare those public comps to our valuations. And again, we assess the similarities and differences. And we also use, when fit, we use traditional frameworks like a book value or a DCF analysis when appropriate. And I think the real important takeaway here is that we don't have one forced methodology. We look at the opportunity, we see what's appropriate for valuation. Sometimes we even use multiple approaches, and maybe if we have three, triangulate to most accurately achieve our goal of calibrating what that maximum price an all-cash buyer would indeed pay. Once we're equipped with that valuation of intrinsic value, we now can determine the implied cushion of business value below our debt securities, and thus the probability that we are impaired. Then and only then can we blend in the traditional credit metrics, the management ranking, and other qualitative factors to most accurately assess our default risk. And moving to the next tenet. So some think of the value space necessarily as businesses that are past their days of peak growth and market share capture, and kind of confine themselves to the domain of very low multiple, stagnating, or even declining businesses. These characteristics are oftentimes reserved for the market share losers, the companies with real strong secular headwinds, revenue shrinking or profits shrinking, or both. As you can imagine, these stories certainly offer premium yield in their respective fixed income securities. But these businesses are often relying on things that we do not want to have to rely on when we are underwriting debt. Now, these things include relying on shrinking cash generation to pay down absolute debt levels, relying on divestitures, maybe even core divestitures, including key business parts to prop up liquidity and handle upcoming maturities, relying on capital market openness to refi maturities, or relying on market buy-side demand. We all these things are red flags to us. We believe they're traps. They're not always traps, but they're oftentimes traps. And they're generally things we avoid. Having to rely on any of those three things: absolute debt pay down, liquidity through divestitures, or capital markets, really puts an investor in a position of weakness when assessing default risk. And I think you can just ask the folks who bought the directories businesses because of the free cash flow and the great amortization schedules in the early 2000s. Yeah, the cable overbuilders, the E&Ps in 2015 that relied on capital markets. Sole reliance on any of these categories to not default is a big red flag for us. Instead, at Harris, we focus on companies that can organically reduce their leverage. What does that mean? We invest in companies that we believe can grow their business value per unit of debt over a long time horizon. This means today we look for market share winners or secular growers or businesses with pricing power. We want appreciating businesses. We want appreciating business value to de-risk us through growth. And I think the flywheel effect from organic deleveraging means that companies will benefit over time from lower cash interest costs, what they can dedicate for capital allocation that optimizes future growth, which then they can create more organic deleveraging, which will then reduce interest costs, and the flywheel spins. And when you invest in stagnating or declining businesses, the flywheel can work in reverse quite effectively. In the absence of growth, as profitability declines or stagnates, cash generation is often relied on, is forced as one of the remaining tools to address debt pay down, bring leverage down, or at least maintain the current levels, maybe to stay under a covenant, which means cash and capital allocation is no longer being optimized. And we have an example in one of our trades example, a great example of this. There is no capital allocation is suboptimal, massively suboptimal, because you're protecting your balance sheet and your peers are out there allocating capital in a more efficient manner. So the flywheel works very effectively in both ways. And on to the third tenet, management alignment. Our final tenet we want to discuss today is, and we'll get into some examples, is really important across the firm's management alignment. This fits in the category that sometimes is overlooked in the fixed income space, I believe, and yet it plays a very important role in value calibration for us. Our analysts drill down into management incentives, historical behavior to assess their alignment with the goal of value maximizing capital allocation decisions. One key category is compensation. Are they highly incentivized as debt investors? Are we looking at a management team that is highly incentivized to hit it out of the park? Let's use an example, and I've seen plenty of these. An executive team that, because of weak prior performance over the previous 2-3 years, owns a lot of their incentive through way out of the money warrants or options. Or maybe they have performance targets that are now way out of the money and require a large inflection in profitability and or revenues. And this might be a red flag for us, especially if their current ownership of the stock is low. They're not going to think or act like owners, are they? They're going to be incentivized to risk a lot to achieve their current ownership. To achieve their goal maybe of maximizing their compensation. Is there a point where they start to think about their own compensation more than the health of the business? Maybe it's a transformative acquisition that they pursue that they otherwise wouldn't have. Maybe it's they just start dedicating every single dollar of cash to buy back shares. So you kind of get the flavor there, but there's a lot of questions we ask. How does management generally evaluate avenues to both raising capital and investing excess capital? Are they smart allocators? Do they have an ROIC framework that it's balanced? How do they balance additional debt versus the ROICs that their invested capital provides them? Where is their limit to where the incremental dollar of debt that they raise to pursue their investments actually becomes destructive to total business value over time? There's certainly a line. And are they aware of that line? Do they have a consistent framework that thinks through that process? Those are all very important questions for us. If we're aligned, we generally are going to have better success in our debt investments. And we want to be alongside management teams that are going to think and act like owners and make these right decisions over time. And so let's put these tenets into action. Netflix, what does it really mean to take an intrinsic value approach to debt? Well, let me explain through this example of Netflix bonds. Over the last 5 years, just as some background, Netflix bonds were some of our largest positions in 2017 when we initiated. The thesis was quite simple, and we oftentimes find, or I have in my career, that complexity in a thesis has inverse correlation to return and success. In the Netflix example, we identified that the fixed income buy-side community was ignoring the incredible growth of value in the streaming subscriber base, and they were really myopically focused on content spend and the related cash burn. And that tends to happen with debt investors, our psychology. If you think about the instruments, this downside asymmetrical offering that debt investors are presented with, you get issued a bond at 100. If everything goes right, you collect your return, your coupon, and then you get 100 back. And if things go really poorly, your outcome is zero. It's simply the same outcome as the stock. So there's this embedded downside asymmetry, risk aversion in bond investors. So you tend to have these great opportunities that exist because a critical mass of the buy-side fixed income community is focused on the wrong things. Traditional credit analysis would look at this Netflix story, focus on cash flow and liquidity, and absolutely ignore the tremendous growth of business value over the last 5 years. So I'm oversimplifying, but in a nutshell, traditional credit analysis would want to answer 3 basic questions. How much cash does this company generate on an LTM, last 12 months, or run rate basis? Does its projected cash cover its fixed costs and bond maturities? And is the company's ratio of profitability to debt, what we call leverage, is that sustainable? And again, we think there's a gaping hole to this approach. If that's where your analysis ends, there's no assessment of how actually the cash flow is being used and how those investments might translate to future business value. So using traditional credit analysis, I included some metrics on the slide. Netflix in 2015, 16, 17 looked awful. If I just gave you a tear sheet of traditional credit metrics, the company was losing large amounts of cash each month to spend on their own original content. Leverage was infinity, right? Because profitability was negative, so it wasn't calculable. The company certainly wasn't going to generate enough cash to cover its interest costs for some time because it was negative. And the company was relying on capital markets to stay open to satisfy the cash deficits. So the traditional analysis might just stop there. This is kind of in a high risk category. There's a lot of cash flow burn, and let's just end the analysis that this should be in the lower quality segment of the junk bond universe, with high default prospects. And as you can see from the slide, at the time, there was 20 to 25% embedded implied risk of default in this business. So now let's use an intrinsic value approach instead of stopping at negative free cash flow and negative profitability and high debt. We're going to think and act like owners and really analyze what these cash deficits were creating in terms of intrinsic value. Of course, the cash Netflix was losing was being dedicated to original content, licenses, and building out the infrastructure, which was helping Reed Hastings amass the most valuable streaming subscriber base on the planet. The content might have been losing them cash today, but enabling the company to build enormous underlying value through a rapidly growing subscriber base. Think about the subscriber base. It was highly engaged, relatively low churn metrics, viewed the product not as only as the best value proposition at the time at $10 to $12 a sub, but versus alternatives, but also increasingly as the best content in absolute terms, both in terms of breadth and depth. It was really the one-stop, and still is kind of a one-stop streaming shop with the best content in the world, a much simpler user interface, and only required an internet connection. So the value proposition was and still is fantastic versus traditional network cable TV. And one didn't have to look, by the time we initiated the position, by the time we got to 2018, you didn't have to look any further than the equity markets, which began reflecting the intrinsic value that was being built. By mid-2018, the enterprise value was around 180 billion. And the company had passed 120 million global subscribers. But still, amazingly, at the time, the debt securities with traditional fixed income managers still focused on focusing on negative free cash flow, and really all focused on this inflection point in the future where they were going to be break even. It still implied a near 20% 5-year cumulative chance of default, which still placed it in the highest risk category in the entire corporate bond universe. So our approach focused less on the free cash flow burn and more on what the content it was going to build was creating in terms of future value. We focused on growing ROICs. If you look at the green line, we graph ROICs over time, just consistently growing. Reed getting great returns on his investments in content. And we looked at the transactions in the space. If anyone followed the Time Warner deal for HBO subs, depending on the assumptions you made for the other parts of the business, you're valued at roughly $1,000 per sub. Applying that multiple in using forward estimates of Netflix subscribers, our debt at the time was covered over 20 times by implied value. At the time, bonds offering the same yields in the low quality single base space had a median valuation coverage of roughly 1 times. So let's walk through the tenets. This is a clear example of debt market not appreciating the incredible intrinsic value of the growing subscriber base. Check. They are absolutely growing the value of the business per unit of debt. In fact, better than that, they're growing sometimes something like 5x per unit of debt that they added from 16 to 20. And they had a management team that understood that how to optimize for growing their subscriber base. They understood that the IROCs that they were being presented with, and they balanced that appropriately with the debt levels never going much higher than 10 billion. So they really checked all boxes for us. Then I'll move to the next example, and then we'll open it up for Q&A. So the last example is kind of a fun one. It's Chesapeake Energy. And we had success in this position in 2020. As a disclaimer, we are not traditional distressed investors, but when we find value across our equity and fixed income using our both lenses, when we find big gaps, big discounts to our intrinsic value, we will act. And this is an example of that. And also a great demonstration of working with our equity team, working with our debt team, and leveraging both sides of the research process to find value. It also is one of the best examples of if you just maintain a disciplined approach around your philosophy, even in the midst of a lot of noise and a lot of short-term technical damage, that you could make a lot of money in a debt position. So just for some background on our debt thesis, we initiated this Chesapeake debt position in a first lien term loan. As the company entered into a restructuring event in early 2020, we really held the opinion that underneath a massive debt pile, 8 billion plus, that was amassed by prior leadership, that the company had a very strong strategic asset base in natural gas in the Marcellus and the Haynesville basins, with a management team that was they were very strong operators and strong capital allocators, but they were just hamstrung by legacy debt, and bad contracts. Specifically 8 billion of debt or roughly 8 billion of debt and 8.5 versus 8.5 billion of enterprise value, and firm transport agreements that had been underwritten for natural gas at high unsustainable levels. So due to liquidity constraints, its debt load, low natural gas prices, management was forced to shift production. And this goes back to when a company has to make puts too much debt on the balance sheet, and then ultimately, if they don't take care of it soon enough, it ultimately gets the flywheel spinning. And this is a great example of that. So due to liquidity constraints and problems around refinancing, this savvy management team was forced to shift production towards inferior oil assets in order to generate cash rather than focusing on their highest returning assets. And our analysts on the equity side followed this company for many years and had built strong relationships with the management team, and thus have developed a deep understanding of the value of the company's asset base, the earnings power of the enterprise once the debt and contract burdens were lifted. Importantly, we believe that the debt restructuring would allow the management team to run the business to maximize value, as opposed to only for survival. That's key, and which would allow then the intrinsic value to converge back to peers. And so, despite a clear pathway for debt elimination and value realization through a restructuring, the prices of the company's debt securities, because of forced selling by mutual funds and other technical dynamics, continue to value Chesapeake debt to imply an over 2.5 turn multiple discount to our expected value. And to bolster our downside case, we further demonstrated that even in a runoff scenario in which no new investments were made and production was allowed to run off at current commodity prices, which were historically low, the intrinsic value of the company was still a full 1.5 turn above what this debt security was implying by prices. And so that provided us with the conviction necessary to make the investment. Over the subsequent quarters, as the company finalized its restructuring plans, emerged from bankruptcy with a clean balance sheet, the market valuation appreciated, converged with peers, and we made roughly 3 times what we paid for our initial debt investment. So let's go through the checklist again. Debt that is implying a discount to intrinsic value. And then in this case, we were buying debt at 55 cents that would be converted into equity through bankruptcy. That implied that Chesapeake was worth 1.5 times EV to EBITDA. So it certainly checks that box. Number 2, we were going through a restructuring to eliminate over 6 turns of leverage so that the company could indeed begin to grow value per unit of debt, something that they did not have the luxury of doing over the previous 5 years. And then number 3, after the restructuring, we were aligned with management who wanted to invest prudently for growth and wanted to balance that with maintaining a strict leverage ceiling around 2.5 times leverage. So that the investment ended up being a home run for us, 3 times return. And it was a fun one. So I will conclude my presentation there. I just want to say that I'm grateful for the time today, and I'll send it back to Graham and we can open it up for questions.
Absolutely. Well, it does look like we have a couple of questions lined up here for us. First of one coming from Jason, beating everybody to the stream, actually beating the start of the stream to begin with. So those of you out in the audience might not be able to see his question currently. And on that note, Jason, if you are concerned about those questions or comments not showing up in the live chat replay afterwards, just wait till we go ahead and get that stream up and running in the future, and then they should show up for you. But he has a little bit of a two-parter here for you, Adam, asking right off the top, what investors inspire you most? And then from there, which have had the most lasting influence on your particular investing style?
Okay. Yeah, I would have to say Howard Marks. I think his investment philosophy in the debt markets is really just an extension of the original value investors, Ben Graham's, the Warren Buffett's of the world. Really, it focuses on ensuring you're buying debt assets at a discount, assessing properly for liquidity, which is a bit unique to the debt markets, reinforcing this approach of the importance of staying invested, of the approach of thinking about things over long-term investment horizons. And maybe the most applicable to the current environment, as a debt investor, do not fill your hours with trying to forecast things in which no one can predict. He had a great piece out a few months ago about the importance of acknowledging what we can have confidence in knowing or ascertain as analysts: long-term market share trends, industry trends, fundamentals, when we dig into the balance sheet, income statement, management calls, et cetera. And then what is unknowable? In this case, he was referring to inflation. And investing, it's certainly important to remind yourself of the certain biases that are so easy to creep in, whether it be confirmation bias, because maybe you got a macro call, right? Or certainty bias that creeps in around things that are fairly impossible to predict. And I think at Harris and in my investing career, we really want to find a thesis that hones in, puts all the weighting or most of the weighting in the bottom-up fundamental analysis where we can add value, where we can gain edge, and avoid a thesis that hidden in it might be a strong reliance on something that is fairly unknowable. Maybe it's a strong reliance on this inflation forecast is going to be maintained. Maybe it's a strong reliance on this exact path for Fed rate hikes will happen. over the next six quarters. The Chesapeake example is a great one in that the discount to our intrinsic value was large, and it wasn't necessarily large because of a bet on the commodity. We didn't need natural gas prices to go to 5 for us to be successful in that investment. But our fundamental analysis highlighted the decoupling of valuation from its peers. We understood why. We kind of wrapped our head around some of those technical forces and why, and we took the position. But it certainly didn't rely on some sort of macro forecast to come true that have very large error bars, and certainly we're not any more capable than any other shop out there at predicting what the government will do or the Fed will do, et cetera. So I would have to say Howard Marks.
For sure. And continuing down, looks like Todd is coming in with a question. Looks like he's coming in to challenge the bonds here, asking, what do you think about bond yields being at 2%, inflation going up to 7%? Where's the thought process at here?
Yeah, I think I think we at Harris, we still believe we take a valuation approach to U.S. Treasuries, rates, government yields as well. Our general house view is that we believe that investors should be afforded, when all this Fed intervention, this QE, some of the stuff begins to be withdrawn. We believe the equilibrium looks a lot more like investors affording some non-zero real rate of return. And that points to interest rates being higher from here. Inflation also is troubling. It's stickier than I would have guessed it to be when I thought about this problem 6 months ago. I think labor and wages, rents, I think we likely should get used to high inflationary prints for some time in those categories. Now, I think the 7% number that you read today, it will come down, and most of that will be not because of labor, wages, and rents. It will be because of durable goods inflation coming down throughout the year. But it's still problematic because I hear a lot of people saying, well, this kind of reminds me of 2018. The Fed can just pivot. They pivoted to hawkish. They'll hike a couple of times, and then we'll pivot back. They'll go dovish again like they did in 18. Everything will be okay. Well, this is a unique time in that I don't really think they can afford to pivot back. They certainly can't afford to pivot back if inflationary numbers stay sticky. And so I do think we should prepare ourselves for volatility. I do expect credit spreads and fixed income to stay volatile. I do think rates need to reset higher. And we'll be, if that is indeed true, again, there's error bars around this stuff. A lot of it's unpredictable. But if that is indeed true, we'll want to be opportunistic. We thought, a lot of last year, we felt the credit markets were fairly rich. And in my opinion, it has now changed. We're back to that fairish value. And now I think we'll get back on the front foot and be opportunistic if we get more volatility over the next 6 to 12 months.
Definitely. I'm going to skip down a little bit here. Looks like Praveen, one of our regular viewers, was chiming in with 1.5% yield on 10-year bonds given rising inflation. So I think we pretty well hit on that one there in that last one. But then he continued on to ask also, do you think a deep recession may be coming around the corner?
No, again, this is, I don't want to get in the trap of trying to predict too much that back to the Howard Marks thread, some of this stuff is unknowable, but certainly the risk of recession, I want to frame this the right way. The risk of recession is growing. And again, I think the Fed mandate here, they have shifted their priorities, and we haven't seen this in some time. They have shifted their priorities to first and foremost take out inflation, and they are willing to sacrifice real growth. Now, the good thing is, even if we punish growth, let's say 3 or 4 points next year, or for the back half of this year, let's say, we still can have an economy that grows at 3-4%, and we can have more real growth in that economy. But I do think the risks, they have to be rising. I think you have a 9 trillion. I think this experiment and, you know, this MMT experiment, we're going to print. I think we're realizing that we're going to have to reverse some of these things. The federal balance sheet at $9 trillion needs to start coming down. Regardless of the economy, it needs to start coming down. We need to get off zero in the Fed fund rate. So if nothing else, to allow themselves some sort of ammunition if we do encounter a recession later down the road. So invariably, I think that the risks to recessions are rising. I don't have any certainty around that, how much that should be. I do think the Fed this is going to be a tightrope act. They have to show the market they're serious about pivoting hawkishly, but they have to be careful not to tilt this into contraction. I still think we can grow. We can still see 3% growth, but when your path goes from, let's say, aggregate demand and what it was last year and 7% growth, and you move down to 3%, it's still great growth, but the market digestive process, this digestion, it's going to cause volatility, and I think that's what you've seen historically when we go through these hike cycles. You've seen a lot of volatility in selling until the hike cycle actually is initiated. And then if you look at 2016, you look farther back, in almost all scenarios in the last 4 decades, other than one, equity markets have done okay. Credit markets have actually done fairly well as well once we get to the hike cycle. But expect more volatility. I think the odds of recession are incrementally going up. And I think that the Fed's got somewhat of a tightrope act here, but we'll have to watch the data.
Definitely. And it looks like a question from Eric came in during the presentation. He said, y'all avoid doing the market timing, trying to make that happen. But do you put any thought towards timing of the market kind of later in that cycle when there might be a euphoria period or something like that? Is that a thought that I guess comes up for you guys?
Yeah, I think it's maybe I'll make an important distinction. We aren't market timers in that we don't wait for cyclical peaks and valleys to decide that we're gonna like a business, that we fundamentally want to own a business over a long time horizon. We try to figure out what a company is going to earn 5-7 years out, and then we set price targets around that valuation over a long time horizon. When you get volatility in a marketplace, so let's say some of our names over the last 3 or 4 weeks have come down quite considerably. We certainly are opportunistic buyers if we can buy the names we like over a 5-7 year time period at a bigger discount. And if those prices go up, which they did last year for a lot of our names through our price targets, that doesn't reflect the long-term value of the business. It doesn't reflect the underlying cash flows or what someone else would be willing to pay for this business, then we sell. And I think the key there is you can be opportunistic about too much optimism in the market or too much pessimism in the market, because it either cheapens your entry point, gives you better expected value as you buy lower, or it allows you to exit your investment and protects your client's money. But you don't want to form the thesis around those ups and downs. And I think when I look at some retail investors and some of the bubbly stuff, the bubbly formation, whether it be in SPACs, some of the high tech multiples, the multiples we were seeing in some of these tech names only 18 months ago, some of the craze around NFTs or crypto, some of that wasn't necessarily, there wasn't a fundamental underpinning to any of that stuff. And so you certainly can be, you want to acknowledge that and maneuver around it.
Understood. And Looks like we got a couple questions lined up here in a row in chat that are asking about different types of investments. We'll I guess we'll jam through them relatively rapid fire here. First one from Praveen, which we hit on a little bit, asking about investing in distressed debt, if there's a specific methodology you guys like to play at there.
Yeah, I think with distressed debt, so when we approach anything that we on the equity side or the debt side, when we approach a new investment, one of the ways we define risk is the amount of discount that we can to buy into versus our intrinsic value. That is, the larger that discount to our perceived valuation, we perceive as lowering the risk of the position. And with distressed investing, again, this isn't our core competency. The Chesapeake example was kind of an alignment of and just a really large decoupling, us being opportunistic around a name we know, and keeping a discipline around our valuation. But in distressed investing, you do have to certainly add to that discount cushion to allow for things like liquidity events. If there are unforeseen events that happen in court, certainly in Chesapeake, there were some events that occurred for second lien holders because how the judge ruled on the treatment of the unsecured claim. So when we're investing, this is true at the lower we go down in quality. The larger the amount of risk as we move down in, or at least perceived risk as we move down in quality, the larger discount to intrinsic we want to have on day one. And so that's really our approach. We realize that we're not going to have a seat at the table necessarily for some of these reorgs. We are at a disadvantage there. We're not going to be in the courtroom every time. But if you eliminate some of those things and just look again 5 to 7 years out, we got to buy a business like Chesapeake for 1.5 turns EV to EBITDA in a position that we felt was fully de-risked just by the runoff value of the assets. You can build a lot of really interesting asymmetrical outcomes there. And so I think in the future, we may be opportunistic around the space if we get a credit cycle again. Our core competency will stay in corporate bonds, corporate levered loans, et cetera. But we'll certainly, if we get a cycle and things line up where they check all three tenets, our equity team might have some expertise in it. We know the management team well. You could see us be opportunistic in that space as well.
For sure. And continuing down our quick little hit list here, Barry's asking about real estate debt, or is this a sector that you avoid?
Yeah, well, it's in there. I guess that requires some nuance. We tend not to make blanket statements on sectors. What I like our team to do, our analysts to do, and across Harris is kind of the methodology is we're not trying to top-down allocate. So we don't say this is a sector we should really be adding to. This is a sector we should just wholesale avoid. What we do is we like to start with the company and build up, see if we can find value at the ground level. And then if certainly as a PM or as a group of PMs, if we notice a trend, well, it seems as though we keep coming up with good value ideas in a certain sector, certain asset class, et cetera. Then we might amass a group of positions in a particular sector. But in the real estate sector, we play in a few names. It's more the reasons we're playing them on the debt side are more for the idiosyncratic opportunity they offer, not necessarily because we necessarily think that the sector as a whole is cheap anymore. It certainly was in mid 2020 when we launched the fund. And so, yeah, I think I'll leave it at that.
For sure. And Praveen chiming in again, asking preferred equity. Any thoughts there?
Yeah, I think it's it's a timely question because the preferred market is starting to reset. And whether it be the money center banks or some of the regional banks, we're not to levels where we think we can identify a big discount to our value, but we are getting there. And I think we're going to be taking a hard look over the next several quarters if the sell-off continues in this class. Some of that is just technical flows. The 10 and 30-year UST selling off has pressured some of the space. So yeah, I think it will be an opportunity in the future to both add credit risk and add duration to our fund. And I think it's something that we're going to spend some time on. I think our core positions we're happy with today, but if we reset lower here, I think you'll see us again this disciplined buy approach. You'll likely see us adding to names we already like and already exist in the portfolio.
For sure. And last one on our quick hit list here, coming from Dale, another one of our usual viewers, knocking us into the end of it here with any M&A arbitrage going on there.
I wouldn't call we don't do merger arb. We certainly don't do traditional merger arb. And the vehicles that I co-manage, we're not shorting, so we technically could not do merger arb. Now, one interesting position that we took recently was actually a byproduct of our equity research was Peloton converts. And I'll talk through that just real quickly, but when we did the analysis on the equity side and proposed it, one of the things the analysts highlighted were the 0% converts of 2026. What we found was really interesting is despite 10 billion of current market value, enterprise value, and our analysts' opinion that the intrinsic value is worth much more. And apparently, he's probably right if Amazon and Nike are really starting to dig in here at the levels we're seeing. But the default risk embedded in those 2026 converts was kind of like Netflix. It was up towards 20%, 20-25% range. And I think that Peloton converts were offered at one point down to 83. And so we started buying. And we bought more as they went down. And it was a really interesting exercise. That's not necessarily merger arb. It's more, you could call that, maybe label that, it's still a fundamental thesis for the origination, but it has now since morphed into an event-driven special situations. Now these converts are $92 price a day. The way we frame that is about 4 points of upside. If the deal is consummated with Amazon or Nike, there's probably still some sort of DOJ deal risk embedded in there, so they will not go to par. If the deal breaks up, they probably resume kind of back in the same territory around 85. And so we're kind of to where the break-even math dictates that we should be selling. And so we've reached kind of that sell discipline. And so that's certainly not traditional merger arb, but fits in kind of that special situations from what's transpired recently over last week.
For sure. And another question from Eric coming in here, asking if you've allocated capital into China. Any thoughts there?
So the products that I co-manage are U.S. domestic products, and almost all of our investments are, at least in the bond fund, are U.S. domiciled USD currency. So I will. That is David Harrow, who runs the international strategy. That is his forte, and Eric Liu, who is an analyst that has specialty in that coverage universe. I will defer to them. I know they like some names. I know they still like Alibaba. I think, again, hopefully not putting words in their mouth here, but I do think they are finding attractive valuation in spots. But again, it's all built on fundamental analysis. It's not necessarily a macro view that this liquidity, them turning dovish just when the rest of the world turns hawkish. That's not really the base of the thesis. It's really that the fundamental valuations for some of those businesses, including Alibaba, if you compare that to some of the tech multiples here, have gotten really cheap.
Definitely. And it looks like our upcoming two questions, I think at least, work pretty well together. So we'll lump them together again. Praveen's asking, in terms of asset allocations, is there a fixed income component that you would recommend for a balanced and diversified portfolio? And then Larry chiming in just after that with if you consider there to be any safe investments with our current economy.
Great question. Okay, so I think that the right allocation depends on, in a balanced strategy, depends on a number of factors, but I'm just going to answer this generically without knowing some of those other variables. I think certainly that if we use 60-40 as the anchor, the traditional anchor, you don't want to be there today. Again, as rates normalize, the Fed influence comes out of the marketplace. The rundown of 9 trillion of assets begins. The absolute reduction probably begins sometime next year. You don't want to be running a balanced strategy at 60-40. Why do I say that? Well, I think there are going to be headwinds to total return for a lot of fixed income assets because of this normalization process that occurs. I don't think that means you're certainly going to lose money, but there will be a normalization that makes the relative attractiveness of fixed income versus equity on a 60-40 basis weak. And that means you probably should shift upwards your equity exposure, maybe it's 70-30. I think there's justification if you are a young person and you're doing the allocation yourself. I think that allocation would be closer to 80-20. So yeah, that's my general feeling. I think there's another point here where historically your fixed income high quality assets protected your equity assets in a balanced portfolio, right? So you have 2008, you pick a risk off scenario. The concept is, correlations go to -1. Your high quality fixed income assets should protect your assets on the equity side. Well, what occurs when you're in this reflationary, or even if some care to guess that it could eventually be a stagflation scenario, these fixed income assets do not protect your equity assets in that environment. And that's what we've seen with the increased volatility and prices moving down in all asset classes over the last 3 or 4 weeks, is that, because we're going down because of inflationary concerns, that fixed income doesn't necessarily provide that ballast or hedge to your equity. So I would say if your anchor is 60-40, let's move it to 70-30. And if you're young and you're playing the allocation game yourself through ETFs, have an advisor, et cetera, I'd like to see you closer to 80-20.
For sure. And looking down our list, I'm going to go ahead and save a few of these just as our kind of, we'll call them ending questions. WK chiming in, asking, and I know we hit on this a little bit, is there a specific discount rate that you like to use to get intrinsic value? And from there, is there a certain percentage for that margin of safety that you like to see?
Yeah, so in fixed income, it's a little bit unique in that we don't necessarily think of it as a discount margin like we do on the equity side. I believe our equity side tries to get a discount to intrinsic around 30%. On the fixed income side, we really like to see a spread opportunity that maybe is 20 to 30% back of the current spread levels. So it's a little different. Spread is, of course, what the market is paying you for embedded default risk in a fixed income instrument. So if you're at, let's say, a high quality 100 over asset, as a general rule, we like to be at 130, and we think if we can point to the fair value spread compression is 30 bips, that's interesting to us. So that's kind of the loose rule of thumb. That changes depending on quality, certainly on asset class, et cetera. And going back actually to, is there anywhere that I forgot to address this question? Sorry about that. Is there anywhere safe in this fixed income world? I assume he meant fixed income. I do think leveraged loans are an interesting asset class. Again, for people who have a long-term time horizon that have patient, steady capital. These are unique instruments in that they own the collateral behind the security, behind the business. They're floating rate, which also makes them unique, meaning that they've just absorbed this move really well with the Fed funds, the front end of the curve rising so rapidly over the last quarter. In a default scenario, in a restructuring event, you own the business. Chesapeake was that example. We were in the first lien term loan, and if things go wrong, you have a claim on the entire business. And so I think those are interesting. Again, you have to have a risk appetite to be in that type of paper, but this is at the intersection of a security that I think can behave well if rate normalization continues to occur. And if you're interested in being able to own assets in a default cycle, let's just play the other tail. I think they're interesting as well. So it's a little bit of a unique asset class. It's only about a $1.3 trillion market. It might be larger now, but for institutional asset allocators, for larger players, I do think they're interesting. For individual accounts, retail investors, you would have to put that view on through a name like BKLN. I think that's BlackRock's floating rate fund. I think there's several derivatives of that now, but I think it's an asset class worth taking a look at.
Definitely some interesting thoughts there. I'm going to throw two rapid fire ones at you here before we end off on a strong one. Coming from Dale, are there any books on fixed income that you'd recommend for anybody in our audience to go read?
I think here's what you should do, Dale. Go to Oaktree's website. Don't go buy a book. Go to Oaktree's website and read as much Howard Marks as you can, and you'll love it. I think it really will. You'll learn about some of the nuances with fixed income, but at the same time, there's a consistent thread of this value process. Again, that harkens back to Benjamin Graham and kind of the godfathers of value. But some incredible insights. I think some of my favorite pieces are in 2015 and 2016 when he talks about his value approach. And then recently, some of my favorite pieces are him really starting to focus in their investment philosophy on ring fencing what is unknowable and kind of putting that aside, maybe embedding into your discount rate. We don't know it. We know there's increased risk associated with this outcome. Maybe it's what the Fed does, et cetera. And then solely focusing on what they can be good at, where they can provide an edge. The deep fundamental work, opening the 10K up, the queue up, reading the management transcript, really understanding what do ROICs look like, these investments they've made, or have they been successful? So I would encourage you, if you haven't done it, just go on that. Again, I think it's all publicly available information now. Go on their website and just read through commentaries dating back to the 90s. It's great stuff.
Definitely. And one more quick one before we hit on our big one to end off on. Any thoughts on the metaverse? Any opportunities there for you?
You know what? I'm going to punt on that one. I have a few personal thoughts, but I don't think I'm sophisticated enough, meaning I don't have the depth of knowledge, a robust view of the outcomes there, such that my view should mean anything, unfortunately. And I'm going to punt on that one.
All righty. Well, fair enough there. And our big one to end off on, Praveen's going to put the pressure on you. Can you speak to a big mistake that you have made and the lesson that you learned from it?
Sure. Yeah, I think I'll just talk generically. I don't want to get in trouble with legal and compliance on a particular position, but I think a really important part of our process is to have guardrails around your investments and checkpoints and benchmarks to ensure that there isn't what we call thesis drift. So I think one of the things I'm still learning, and I think I'll constantly be learning this, but is assessing how to know when the thesis is turned on you. I think on the equity side we call it the poison pond. I more generically call it thesis drift, but build a really good set of guardrails, build an important set of metrics and benchmarks that actually mean something. And they can be your own. They don't have to be given to you by management. By the way, management's never going to offer up the most insightful metric unless it works in their favor. So as you work through this thesis, make sure as you put the position on, as you initiate, make sure to have those benchmarks well defined so that as you look at the coming quarter's results, as management starts to talk over the coming quarters, that you can make sure that your thesis is still intact. Because some of the worst investments I've made in my career are theses that have turned into something else, and I'm constantly re-anchoring and re-anchoring and re-anchoring. And I look back and I say, well, I anchored to 3 different theses. This was why I got involved in the position. It evolved into a completely different thesis, and now I'm owning it because I lost a lot of money. That's not a thesis. And so that's, and by the way, I could spend a lot of time on specific examples. I won't do that. But just a big point of lesson learning for me, and one that we'll continue to deploy when we initiate investments here, is making sure those guardrails are intact and making sure those benchmarks are checked.
Absolutely. Well, Adam, that is going to round out all the questions we have from our audience today. Thank you so much for taking the time, giving us this great presentation, walking us down a path that might be new for some of us or one that we haven't necessarily explored here. It's been an absolute pleasure, like I said. Thank you so much for joining us today.
Yeah, really appreciate it, Graham, and thanks to all your listeners. Really appreciate it.
For sure. And for anybody out in the audience, if you missed anything today, there will be a full recap here on YouTube and on GuruFocus like usual. Please do take a moment to like, comment anything that we might have missed. Subscribe to the channel if you haven't already. We only got 5 likes on this video, and there's still plenty more of you out there. Please go ahead and make it happen. Other than that, though, we are going to wish you all the best moving out into 2022. Hopefully you'll find some strong returns out there.